Very good evening to all of you. On behalf of Auditing and Assurance Standard Board of Institute of Chartered Accountant of India, I welcome you all in today's 140th CP program organized by AASB of ICI this council year. Today is our 140th CP program in the form of webinar, and we all are aware that the topic of today's is very important, and AASB has covered almost all the sector-wise key consideration in auditing. And today, again, we have taken one very important sector, that is the ESDM sector, that is the Electronic System Design and Manufacturing sector. In order to tackle this, we are having with us very learned speaker at a very young age from our Chartered Accountant fraternity, CA Utsav Dogra ji. So on behalf of AASB of ICI, I extend warm welcome to Utsav ji at this AASB Zoom platform and this webinar. And we are fortunate enough that we are having the past chairman of Amritsar branch of NIRC of ICI, CA Jitendra Bansal ji. I extend my warm welcome to you, past chairman Amritsar branch, CA Jitendra Bansal ji. Namaste. On behalf of AASB of ICI, I extend warm welcome to you for this, and thank you very much for acceding to our request for moderating this webinar. Honorable Chairman and Honorable Vice Chairman, AASB both are stuck up in the one of the another meeting. So I request the past Chairman, Amritsar Branch, C. Jitendra ji, to please start the proceedings of today's webinar. Over to you, sir, please.
Thank you, Anil ji. And respected CA Utsav Dogra ji, our young dynamic guest speaker of the day, in absentia CCM and Chairman of the ASB of the ICIC, CA Dr. Sanjeev Singhal ji, and Vice Chairman CA Vishal Doshi ji. My dear friends, professional colleagues, students, ladies and gentlemen, a very good afternoon to all of you. Members, I am thankful to the CCM, CA Dr. Sanjeev Singhal ji for giving me this opportunity to act as moderator for the today's webinar on the topic which is very interested. Key considerations in audit of electronics system design and manufacturing sector, organized by the Auditing and Assurance Standard Board of the ICI. Members, you are already aware that system of audit has been changed drastically in the last decade. Now the seniors as well as young members need regular upgradation in this field. I will not take much of your time, and I introduce our guest speaker, CA Utsav Dogra ji. When I was reading this profile, you will see that he just qualified in the year 2016, but he has a lot of experience in the various fields. Now I read it. CA Utsav Dogra ji is practicing fellow member of the ICI, qualified in the year 2016. Certified in FAFD from ICI, a member of the CAP Australia, and a graduate from the Delhi University. He holds specialization in audit of subsidies of foreign company established in India entry-level strategy, GST advisory, and litigation and compliance and litigation in international taxation. Right in the year of qualification, he has been appointed by the CBIC as master trainer to the IRS lobby and other officers for GST, backend and front-end application. He has been invited by the various commissionerate of GST and many corporates to deliberate on various topics of GST and in-house corporate trainings. He is invited as guest faculty to impart training to ICAS prohibition officers and pay and accounts officer of various ministries at the Institute of Government Accounts and Finance, National School of Drama, Ministry of Micro, Small and Medium Enterprises, etc. on various topics. He is regularly invited by the ICI as a guest speaker on the webinars. He was a special invitee to the prestigious GST committee of the ICAI for the year 2021-22, and currently is a special invitee to the Student Skill Enrichment Board, BOS operations. I welcome CA Utsav Dogra ji, and please continue with your presentation. Thank you, members.
Thank you so much, sir. So I would like to first of all extend my thanks to the chairman of the AASB board, Shri Sanjeev Singhal ji, and the vice chairman, CA Vishal Doshi ji. And I would also like to thank CA Jatinder Bansali ji for giving this introduction. And again, I would like to thank everyone for inviting me for this very important session today, because this is a very specific sector that we have been talking of, the electronic system design and manufacturing sector itself. This is contributing widely to the growth of the Indian economy, and a lot of companies which are from foreign countries are putting up a lot of investment in India. So for the chartered accountants who have been auditing these ESDM sector companies, it is very much important to pay attention to certain points, because a lot of points are there in this sector which leads to litigation for the companies, as well as may lead to some complication for the auditor as well. So without taking much of your time, I would like to start the deliberation. First of all, I would like to introduce this sector a little to everyone here. So this sector of electronic system design and manufacturing, it actually is a completely specific sector which is focused on the manufacturing of the electronic items, Internet of Things, mobile phones. You will get to see a lot of things which are being manufactured under this sector. Specifically, the sector can be divided into three parts. One part is the design of the product. The other part is the mass production of the product. And the third part would be the repairs and services which are associated with the product. A lot of companies are there which are doing as the basic design manufacturers. They are called as the original design manufacturers, the ODMs. We get to see that a lot of foreign direct investment, which is also coming in India under this sector, that also come under the same ODM sector itself. So they in their own countries, they actually design the product themselves. Then, basis on the criteria of the final customer, the customer being the other big companies such as Nokia or Samsung, maybe. So, basis on their criteria, they develop a prototype. Once the prototype gets through, they start manufacturing of the prototype in India itself. So the ODMs, they are doing their research job basically outside India. However, they have put up their factories in India. Either they tie up with the other factories in India, or they just get up their own setups in India, and then they start doing the manufacturing operations here. The second is the mass scale operators, where only the manufacturing is happening, where the research and development is not the part of the manufacturer. They are just manufacturing on behalf of the ultimate customer, being the brand owner themselves. However, when it comes to the manufacturing operations only, then a large question about the ownership of the IPRs and the usage of the IPRs through the process becomes very substantial to understand in that case. Then the last part comes only which relates to the repairs and maintenance services or the after sales services. That is another big associate of this ESDM sector, where the companies which are framed only just to take care of the warranty cycles of the products which are being sold under this sector. And a lot of companies which set up their own manufacturing facilities, they do not take up the process of repairs and jobs. So they try to extend it to other players of the sector. So some of the big examples of this sector are like Dixon Technology, Ember Enterprises, Centum Electronics, and this sector actually spans around various other sectors like automotive, transportation, telecommunication, medical and healthcare, clean energy, and mobile phone, IoTs, LED panel, etc. One of the major concept behind taking this EDMS as the focus point for today is that the large size of their balance sheets. Since they play with the numbers in terms of the manufacturing, when we call the product manufacturing is at a very huge scale. The balance sheet size is huge itself. And however, when you see the profit margins of the sector, they are very limited. So basically, the sector can be further dissected into a high volume and low profit margin, high volume and high profit margin. That is to only various very particular things like IoTs. IoTs have large volume of production as well as large profit margins. Whereas if you take the consumer electronics like mobile phones or televisions or washing machines, fridge, etc. So there are large volumes involved into it. However, the profit margins are very much reduced. So this reduction in the profit margin from year-on-year basis, you can sometimes see in the balance sheet, which is also coming. Becomes a point of litigation, and when we go to the tax authorities with our squeezed profit margins, so this becomes a question that needs to be fight out upon, that how come your sales are improving, your quantities are improving every year, however your profit margins are decreasing. And then comes the low volume and low profit margin, which are like the automotive sector, the ESDM, which is being used in the automotive. They are very much in the low volume of production and gains a low profit margin. Whereas a specific sector that you can see, the telecom, in terms of the tower building and setting up the network for the telecom, or the aerospace and defense sector that you see. So the production volume is very low. However, the margin for this particular is very high. So this sector is basically dissected basis on their terms of volume of production and the margins they are earned into 4 parts. Taking further, as I told you that this sector has majorly 3 type of companies. One of them are the original design manufacturer. The other of the second one, I said the EMS or the electronic manufacturing sector, and the third one is the after sales services. So if you talk about the total growth of the sector worldwide, so in the year 2021, it was about $880 billion. However, in the year 2026, it is expected to grow by 1.15 trillion US dollar. So this is a very important sector, as well as when you talk about India. So India's share is said to be about 32.9% for the year 21 to 29 for this particular sector. And this is huge for India to be concerned of. So I'll start putting up this session in a way that I'll start taking up the heads in the balance sheet, and I'll start talking about them. And not just from the perspective of audit, I will also take you to the various other sides which are relevant for the auditor to see, and various other regulations which are attached to in this particular sector. And further, I would like to elaborate upon those extra, so the other acts and the extra audit techniques that you may apply while doing the audit for such sectors. So starting from the property, plant, and equipment in the balance sheet. So basically, as I told you, that there are 2 type of companies which are majorly playing in this sector. One is the ODM, original design manufacturer, and the other is EMS, which is the original manufacturer of the goods which are being produced. They are giving the manufacturing services. So a lot of number of times it has been seen that while putting up the factory by the ODM themselves, a lot of plant and machinery are being exported directly from the head office to the Indian backend office. So the plant and machinery which is coming back to back from the head office. The one important question comes here from the TP standpoint of view, is that what is the valuation of these plant and machinery? Basically, the head office themselves do not produce the plant and machinery most of the time. They buy it as a back-to-back assignment. They buy it from the third-party vendors and then sell it to India. So in such a case, having a look upon over the documentation that has been prepared by the head office themselves also become very much necessary for the auditors, because auditor may be concerned about the valuation of the plant and machinery that has been put to the frame. However, the TP authorities are always concerned with the fact that how much profit margin has been charged by the head office while transferring the plant and machinery to India. Similarly, various times it has also been seen that some of the plant and machinery which has already been used by the head office there in their own country, they are being sent to India. So the appropriate depreciated value of the plant and machinery as per the books of accounts of the head office, whether the same has been carried or there has been a margin that has been put onto it. When we see it from the point of view of transfer pricing, this becomes a very important question. However, when we look at from the point of view of a statutory auditor, this again becomes important because your depreciation and your profitability is also attached therewith. So while doing the audit for property, plant and machinery, it becomes very much necessary for us to understand how much portion of the plant and machinery has been bought as in back-to-back arrangement from the head office and how much of the plant and machinery has been bought as a second-hand plant and machinery. The third point, which is very important here, is that most of the time, these companies who set up their manufacturing facilities in India, the ESNs, the EMS, they also take their registration under various schemes of Ministry of Electronics, MEI, Electronics and so MEIT schemes, they like PLI scheme and PLI 2.0 have been floated specifically for this sector. So there we also have to understand whether they report their plant and machinery, which is second hand in nature, whether they are first allowed to take the benefit of the second hand plant and machinery that they are buying, and secondly, whether they are required to give a declaration specifically for that, because this may hamper, from the statutory auditor's point of view, this may hamper the company in future litigation. So in case that has not been done, so you can always put the qualification, it may not become a qualification as such, but however, you can put it in your audit report in the other matter para. So you can give an emphasis on the fact that the particular company has taken the benefits of I can say PLI scheme. However, the plant and machinery does not qualify to be in the PLI. So this may also impact the company financially as well. Similarly, once you set up a plant in India, a number of times it has also been seen that a lot of expats, they travel India during the setup phase. And when they are traveling in India in the setup phase, majority number of times we see that the cost of those employees who are there in India on secondment, they have not been accounted for in the books of accounts of the Indian subsidiary. So in that case, it becomes very much necessary from the point of view of GST now, because GST again also asks us to pay GST under reverse charge under Schedule 1, whereby we import the services from our related parties, even if it is FOC. So in many cases, we see that in practical that these companies, they bring a lot of employees at the time on secondment, and they do not pay for their services. So in such a case, valuation again will become a question, and this may lead also to a litigation with the GST department at the time when the scrutiny assessment is going on. So as an auditor, I would always recommend you to take care of the fact that how much payroll is being run, specifically at the time when the plant and machinery is being set up, and how much expenses are being made for the purpose of these secondment employees. There must be some stay expenses which you must be bearing in the company. There must be some other expenses that you must be bearing for these employees. However, for the secondment and for the entire operation, there may not be an invoice which is being raised by the head office. So then it becomes a question of cost allocation as well. So from TV standpoint of view, it becomes necessary. Also from the point of view of GST, it becomes necessary. So again, if this has not been done in your company, you can always ask the management why it has not been done, if they want to account for the expenses. And if they don't account for the expenses, you can take the necessary steps in it. The third point from the plant and machinery which arises is the intangibles which are also involved in the process of production itself, because this complete sector I told you is divided in two parts. One is the original design manufacturer, and the other part is the EMS. So sometimes the original design manufacturer do set up their own factories in India. Sometimes they do not set up their own factories in India. They open with their trading companies in India. So the trading companies are basically getting the designs from the ODMs to the EMS, and EMS, basis the design that has been given to them, is actually doing the manufacturing exercise for them. So if they are doing the manufacturing exercise for these ODMs, EMS, whether they hold the IPRs directly from the Indian vendor, or they are getting the IPRs from the head office, the ODM themselves. So it becomes a little confusing here. how this all operates. So this is a very standard procedure. This is how a lot of companies which are coming from foreign countries into our land in the ODM in particular, they are not setting up their factories in India. They are setting up only their trading units in India. They trade with the already established manufacturing units here in India, where they just give their designs and get it custom made for their customers. And from the customer, it from the vendors, it actually goes back to the customer. So only the trading company is managing the complete sale and purchase here in India. So to tackle this particular the particular intangible part, the auditor needs to be very much reading the contracts between the sometimes there are tripartite contracts between the ODM, the EMS, and the India entity of the ODM themselves. So the auditor has to read these contracts. So these third party contracts are very much important. They may also include the part of the intangibles. The intangibles may not be covered in terms of value, but they are covered in terms of the technology exchange. In case the EMS is getting any kind of technology other than the technology that they have already put in, then the valuation of such technology also becomes a part of question. Because that as a question not only arises from the custom point of view, but it also arises from the GST point of view. So as an auditor, I would always recommend you to read the tripartite manufacturing contracts when you are doing an audit for the EMS factories, because these EMS factories have a lot of customers. Like you'll get to see they make for various, let's say for mobile manufacturing, let's take the example. The same EMS factory would have been manufacturing for Vivo. The same factory would have been manufacturing for, let's say, Samsung or for any other mobile brand. But since the ODMs are different for all of them, however, the line they have set up that run on the same process, but the ODMs are different for all of them. So they make the customized changes as per the requirement, and then they run the complete manufacturing exercise. So in such case, IPR become a very important question. Many a times it has been seen that the custom authorities also raise a lot of questions when it comes to the IPR also, because that needs to be, as per the custom law, needs to be included in the part of the imported inventory, the raw material that they import. The third thing that comes to my mind when I talk about the asset side is the rights to use. Sometimes it is being transferred, sometimes it is not being, it is deemed transferred. Again, the way I have been telling you, but again, the valuation becomes a very important question here. Then we have inventories as a part of it. So while valuing the inventory, again, I'll take you to a practical situation where inventories become a very necessary part, because as I told you that a lot of ODM manufacturers, the design manufacturers, they do not set up their complete manufacturing unit in India. They get the services from EMS, the electronic manufacturing service provider. That means the one who is manufacturing the product based on the design given by the ODM. So to take care of the entire manufacturing process and the complete cycle of sale to the customer, they set up their warehouse unit or their, you can say, their back-to-back wholesaling unit in India. So the wholesaler is actually purchasing from these ODMs. ODMs themselves, most of the time, sell the raw material for the production from their factories to the EMS themselves. So at the process of selling the from the raw material to EMS and then converting it to the finished good and then selling it to the ODMs, the warehouse, and then from there to the customer, the intangibles does not get reflected in the books of accounts first. Then the valuation of the inventory, which is for the import of raw material at the EMS, that becomes distorted. Because you'll get to see that if you look into the balance sheet of some of these warehousing units in India, that the profit margins are very high. However, the inbuilt cost of the ODMs, you can say the R&D cost and the cost of the inventory intangibles that are being used to manufacture these products, that is not being reflected anywhere. Because ODM has already done its research and development. They have already got the prototype approved from the customer, and they have already given the technology also. But this cost has not been inbuilt in the value of the raw material which is being imported. So this becomes a very much big litigation point of view from the perspective of customs here. So the warehousing unit or the wholesale unit that you set up in India, the ODM setup in India, they get to be having a huge amount of profits into it. So to transfer the profit, most of the time it has been seen that they pay it as FTS or they pay it as the royalty for the fee. However, the same is not included in the value of the goods that have been imported. So from the customs standpoint of view, this becomes a challenge. So as an auditor, we have to again see the transactions which are being taken care of through the tripartite agreement. How much is the value of the intangibles and tangibles which are being bought into the process of manufacturing, and only then you get to understand that how much should be the value of the inventory. This is point number one, where the valuation of inventory becomes a weak point of view. The second point that we need to understand is that many of the times which I've seen that these contracts are back-to-back contracts from the standpoint of view of the warehousing unit in India, or you can say the wholesaler unit in India that they set up. So the wholesale unit, they get the contract from the customer and they give the contract to the EMS, the manufacturing service provider. The manufacturer service provider, without even delivering the goods to the warehousing unit, they directly sell the goods to the customer at the end. And the warehousing unit only takes care of the back-to-back billing, right? So once the manufacturer is ready with the product, and the testing team has given a go ahead for the same, the warehousing partner, or you can say the wholesaler unit, they also make a back-to-back invoice, and the goods are directly shipped from the premises of the manufacturer directly to the customer. So at the end of the financial year, you'll get to see that there would be always a disbalance between the number of units that has been sold by the wholesaler and that has been received, because they're always in transit. So many a times it has been seen that since the invoice has been made, because it is very much necessary to transport the material from the customer, from the vendors to the customers. So they make it as their part of their sale. However, the contract, if you read, unless the goods have been received by the customer, they are not recording them in their books of account. So that means that the customer is also not accepting the risk and reward unless the goods have been received. However, we have already shown it as a part of our profit, since the sale invoice has been already given. So in that case, this becomes a challenge for a lot of industries in this particular sector, that how to value the inventory in such a case, how to recognize the revenue in such a case. So from the auditor's point of view, I would always request you to carry out the cutoff procedures at the end, so that you will get to know that how much material which is already there in transit, even if the invoice has been made for that. From the GST point of view, you have to take care of the same in the balance sheets, whether the profit should be added into it or not. Also, at the same time, since it is a back-to-back invoice, the vendor has directly sold the material to has shipped the material directly to the customer. We might be also having a clause in the contract that unless the material is reached at the customer premises and they have given a proof of delivery for the same cannot be accepted by us as well. So at the time when you purchase the material, that also needs to be shown in your goods in transit from the purchase point of view as well as from the sale point of view. So inventory becomes a very important point here. In case you find out any disbalance in it, because the same needs to be reflected again in the income tax return as well, because right now they have also come up with a new notion that the tax which has been deducted on the purchase of material, that has to be claimed in the same period. So in case there is a disbalance between these closing date transactions, so again, the credit of TDS that you would be getting would also be disrupted here. The second point that would be coming to my mind is in case of GST also, this become a disbalance because you have already made a tax invoice and you have reported in your R1. However, the same need not to be accepted, has not been accepted or reached to your customer so far. So for the purpose of that, only you need to make a reconciliation for the revenues also at the end, and also to report the same in your GST and 9C in the reconciliation statement. The next point that comes to my mind is about the trade receivable, because these companies basically have a lot of transactions from their own counterparts in other part of the world. So a lot of trade receivable and payables are there. Since a lot of material is being imported from the other countries, since these ODMs in India, they are not doing a lot of research here. And since the research is not much prevalent here, so most of the companies which are ODMs, they have put up their factories just to carry out a back-to-back process of manufacturing. There may be maybe a number of reasons why they have put up their factories. Some may be cost related, some may be because of the schemes that government of India is bringing to promote the Make in India. So there may be a lot of number of thought process behind putting up a factory, but for sure this sector has brought a lot of numbers to the Indian economy as well. Yeah. So since a lot of transaction of imports is also happening, a lot of transaction of export is also happening, and that too is just being controlled by the related parties themselves. So it becomes again a very big question from the point of view of TP as well as from the point of view of GST over the valuation of all these receivables and payables. So you need to be very much considerate about while doing the audit that whether the receivables and payables they are from the point of view of FEMA, they are getting clubbed, or whether they are getting set off from each other, or being from the same level of transaction, nature of transaction or not. Because in case the FEMA does not permits you to cross the transactions as such. However, if it is of the same nature, it can be crossed. Then comes the loans. This become another very important point. Majority of these companies which are working in India in the ODMs and EMS sector, they bring a lot of ECB to India. So when they bring a lot of ECB to India, this becomes again a question of how much is the rate of interest that is being charged. There are permitted limits to the rate of interest, whether the interest is being charged and accounted for as per the IFRS, so as per the Ind AS and as per the accounting standards which are applicable in India, whether they have been calculated and put onto the places correctly. The second thing which comes to my mind when I talk about the ECBs is their RBI compliances which are associated with the ECB. And the third thing that comes to my mind is the TP standpoint of view from the ECB point. So you need to make sure as a statutory auditor that the agreement that which is made for the ECB, be it in the foreign currency or Indian currency, it is made absolutely in clear terms. Most of the time it is very clear because it is regulated by the RBI, and the bankers have to have the complete agreement for the ECB. So most of the time you'll find them very clearly made. However, there may be a chance that from the statutory auditor's point of view, I'm telling you, there may be a chance that they might have not opened the figures of how to deal with the fluctuation losses and gains when it arises. So that you need to pay a little attention over it, that how the fluctuations are being taken care of in case of repayments of ECB, or whether if the repayment is not scheduled in the current year, whether the expense of interest has been accounted for correctly or not. I believe this gives you a good insight over the balance sheet of these companies, because these companies are basically run by their head offices, which are in the other countries. A lesser number of companies you will find who have their complete offices in India, who takes complete independent decisions in India. A lot of companies get hampered and get actually invaded by their head offices, which are there in the other countries. So once you get to sit with the management, once you get to understand about the companies and its working, you'll get to see a lot of things which are around it. in particularly in this sector. Then the third thing that I need to talk about over the current asset, I guess I have covered all of it, and the fixed assets I have covered all of it, which were the necessary points that needs to be understood from the stat audit point of view. Let us go to the equity portion of the balance sheet now. When we talk about the equity portion, you'll get to see that a larger number of companies are bringing a huge amount of FDI to India. Ever since the FDI from the bordering state has been controlled, because this sector used to be at 100% automated route. Ever since the sector has been barred from the 100% automatic route for the countries who share land borders with us, namely China was the largest contributor for us, and ever since the approval process has been brought into the picture, the FDI movement in this sector has declined. However, with the correct approvals, with the correct measures, most of the companies are also able to take the approval in time. Whereas in case it is a government prerogative whether to allow the FDI in a particular sector or not, in case it is under the government's approval. So the FDIs they are bringing from various countries, and FDIs are moving in this sector like rapidly, and the compliances also get attached to it. Also, the auditor needs to assure that the compliances have been done completely, because the same needs to be either reported by the auditor or needs to be mentioned. A lot of things that you will find from here is that you will not find a particular space for writing them down in the audit report sometime. So the other meta para has to be used extensively wherever you find that this particular law is not being adhered to, or maybe which is not given a specific place in the CARO reporting or somewhere. So you can always put that because as much as you will give the information to the user of the balance sheet and your audit report, it will be more safer to you. So, coming to the equity portion of it, since the FDI is involved, then RBI compliances are supposed to be taken care of. The FDI comes along every year. There is a reporting to the RBI for FCGPR. You have to the initial reporting of FCGPR, and then every year the FLA returns has to be filed. Majority of the times, you also get to see that the companies they sell off their share capital of within the countries outside India. So in that case, the reporting has been properly recorded in the shareholders register in India or not. That also needs to be taken care of. Increasing in capital and sometimes the right issues and other things. So you have to be very cautious about how the things are being taken care of in terms of share capital in these companies, particularly in this sector, because a lot of foreign exchange movement is involved. Once you get to see the foreign exchange movement therein, there are the compliances of FEMA and RBI needs to be taken care of thoroughly. In case the company will I tell you an example of a company for which we had to go for about 7 to 8 years for compounding with the RBI. Therein, the company has not initially issued its share certificates, or it has not got its shares stamped from the authorities, and thereafter they had not also filed their RBI returns for a long time. So we had to go for about 6 to 7 years of compounding altogether for that case. So once you get to see how the share equity is being planned in the company and how it is flowing in the company, you'll get to also understand that the auditor needs to see the compliances are also being in the place or not. The borrowing that I have already told you about is from the ECB standpoint of view. There is a lot of you can say foreign exchange fluctuation, which is a question here that needs to be taken care of. The rate of interest that needs to be taken care of. These are from the point of view of TP as well. Because at the time when you would be searching out for the margins for the TP also, that needs to be taken care of. Then provisions. A lot of provision these companies make at the time of their balance sheet closing, and the provisions need to be coinciding with the contracts that they enter into. Because for the warranty, let's say, because there are a lot of situations where the customer goods are being sold and statutorily their warranty needs to be accounted for. whether the company has accounted for the same or not, that needs to be taken care of here. And the tax liabilities again is a major question, which comes to my mind every time when I think of these companies, is that how do they manage to maintain their profitability throughout the years? So from the statutory auditor point of view, as I have already told you, that this particular sector is divided in terms of their volumes and profitability into four parts. So the customer goods and electronics market is huge in number of volumes, as you can say. However, the margins are very low therein. Whereas the IoTs, again, the value is very high in terms of number of production, and the margins are also very high. If you talk about the defense sector products, the products from the telecom setting up and aerospace, here in this particular manufacturing units here, the volume is very squeezed. However, the margins are very high for them. And for the automotive, as I told you, that the volume is also less and the margins are very less. So at the time when the profitability has been accounted for, the ratios, financial ratio analysis that you are holding, you have to be very sure about the fact that the previous year's figures are also taken care of in your ratio analysis, and you should ask questions upon why this year in particular, what sort of material has become this expensive, or what sort of services. Because you'll get to see that these balance sheets also includes a huge amount of foreign exchange, which should have contributed as their margin to their head offices. And in a very famous litigation in recent past, you would have seen that a lot of uh, uh, cases have been brought by the income tax as well as the GST department over the payments of the royalties and the FTS, fee for technical services, paid by the mobile phone manufacturing companies in particular. A leading MD of a particular company has also been arrested for this kind of disbalance, wherein the FTS and the royalty that has been paid by these companies had not been included in the value of the custom. So you have to be very cautious about it. Whenever there is a payment for these particular values to the foreign countries, you have to be very cautious about whether a proper TDS on the same has been deducted, DTAA has been taken care of. Similarly, whether if there is a direct import back to back from the head office, and the same is being paid with the royalty or FTS, whether the same has been included in the value of your imports or not, because as per the custom it is required. There becomes a point of litigation for the customs as well. One more thing that just came to my mind, should I tell you that at the time of finalization of the balance sheet, you have to be very much vigilant about, as I told you, the previous year's figures that has already been placed by the company, because many a times it has been seen that the current year's profits that are being adjusted by these companies on account of the failure of material. They sometimes say that the material which is there in the third parties uh, can say vicinity is already defunct, or the material has become stale, or they cannot be used. So you have to be very much cautious about it at the time when they put all such kind of expenses into the balance sheets. I'll come to the revenue part. I have already taken a little about the revenue part, revenue recognition, just from the point of view that whenever there is a back-to-back contract, you have to make sure that there is a proper reconciliation of all the items that have been sold around the closing dates. If the same has not been accepted and the contracts does not support the transfer of risk and reward, you need to make sure that the same has not been included in your revenues, and it has been shown in the goods in transit part, and the profitability should be reduced by that amount. In the terms of employee benefit expenses, as I told you, in this particular sector, a lot of expats are working in India. They are bringing a lot of values to India. And in a very leading case, in case of Samsung India, if you would have heard, in this particular sector only, the managing director, he had been considered to be as the PE of the head office. So that from that point of view, it becomes very much necessary for the auditor to see whether the expats that which are working for the company, whether their expenses are being also taken care of the way they match the revenues for the company also.
One
So
point
that
is there.
yeah,
Sorry to disturb.
yeah.
Some years back, there was a Reebok. I think guess, not guess, but it's, I think sure because some of
So you at the closing date also you can see because there is also a reporting from Caro standpoint of view that these all companies have taken their also correlate from the point of view of physical inventory calculations and checking that you can also do in case you find there is a difference in the audit because ultimately all these factories needs to be visited by the auditors themselves. Most of the time what we see that auditors do not visit even the factories.
but actually you can visit the factory, but sometimes there are various showroom in various cities. How is it possible to visit?
So
It is
it
very
is not
difficult.
possible.
And
It is
even
not
you visit
possible to,
also, you cannot
sir.
open the box.
Sir, in that case, I will take arrangement has actually been done. Whether the stock is being accounted for as their own stock or is it a stock for the warehouse? And whether warehousing unit, because most of the time, what I have seen that these sectors they actually make different companies for the warehousing. They make different companies for their retail units. So from one companies to another company's point of view, the auditors at the other unit, which is actually that of the warehousing unit, they have to ensure that the stock is lying there.
And one thing is more, one question is there. What
Yeah.
scope remain before small and medium practitioners?
For the small and medium practitioners, sir, since this sector is very big, and most of the companies that you will see here are at a larger balance sheet structures. So basically, you have to see for the medium and smaller practitioners' point of view, is that you cover the entire balance sheet, the entire area of the balance sheet, point wise from one to another, and you get to see that whether the contracts which have been framed by these particular companies, whether they are in place, and you read them really well, because the contracts holds a lot of value. That is what I have been emphasizing on 2-3 times during my deliberation also, that we do not get to read these contracts. These contracts are about, sometimes the contracts extends to about 500 pages. So out of lethargy, or you can say out of ignorance, we sometimes get to lose the contract. We just see the valuation part. We just get to see the parts from the point of view. However, we always lose the point of seeing the exchange of the IPRs, the real exchange in value of the manufacturing technology. And this is a very important point of view in this particular sector, because the technology is all coming from outside India. It is coming all from the head offices. There are very less units which have put up their research center in India. They have put up their manufacturing sector for sure.
Right.
You'll get to see a lot of companies have put their manufacturing units around. But the research units
Second question is there, where quantitative stock is not possible to verify. What steps should be taken to report the same?
Sir, in case you are not able to verify the quantitative stock, you have to report it. If you find that the quantitative stock, like from the site of it or from the books of accounts, it is not matching at all, so you have to put a para in the auditor's report. And
So this is
also the
one
same
question.
needs to be
My
put
personal
from the
question is
Karo's
also there.
perspective. From the Karo's perspective, it also needs to be put there.
But in some cases, especially in electronics or in manufacturing units, sometimes there is a stock which is lying with the various warehouses, but we can't show it whether it is working or it is obsolete. The book value is there. but
Sir, in
sometimes it's
such
not
sir,
working.
in such a case, you can do a surprise visit check for the same, because every manufactured item in this EDMS sector particularly has their expiries also, which are associated with the box itself.
No, actually, it is if it is has been manufactured and still not packed, then there will not be any manufacturing date will be there, na?
So then, in case it is not packed and it is not ready to be shipped, then in case it would be in the WIP till now,
Yeah,
because the packing cost has not been lied
because
on
there are
you. Then you
so
have
many
to,
various
then
parts.
you yes, that is what I'm telling you. Because when you completely audit a factory, you have to first take the plan of the manufacturing, that how the complete the when we call it flow, how the complete flow runs actually. So basis on the flow run plan, you have to sometimes sit with the engineer and to understand what sort of exercise or what sort of inputs have already been put in, and thereafter you will be able to find out that at what grade the product is at and how much is the value that would have been inbuilt in so far. It will be
But
based
sometimes what
upon
must
the
happen?
production plan.
Sometimes what must happen, because they have up now assembled various items, and out of that, so estimately we will take
90% of the cost that actually comes from the PCB, which they make PCBA in India, and it is labor cost that which they are actually putting into it.
yeah,
And after that, they are just pasting two part and making it a new product.
new product. Yeah,
Yeah. So in that case, sir, you have to see that how much portion of the material has already been put into the system. Because
no,
there would be always
if,
bifurcation. You'll get to see their factories. They're very, they're not the usual factories. If you visit the factories of EMS, you'll get to see that they are very much classified in terms of the floor completely is very much intact and arranged.
no, sir.
Right.
Sometimes just like in electronic in Samsung, just say we can say in Samsung, what is if some mobile is there, and if it is say 2 years back, they have a stock of one items, but now the value of that product is has already been reduced.
That product is already redundant. That product cannot be reused also. This cannot be broken down also. Many a times they buy the old products to fulfill their obligations also. Because
Right,
as per the environmental law, they are also supposed to recycle their product. So instead of recycling their product, they actually buy back the old mobile phones and recycle them.
right.
And this
Thank you.
happens with a lot of electronic industries like television, mobile phones, fridges, washing machine, every such sort of customer goods that they are selling. This kind of exercise is going on with them as well. So that case also you have to be very cautious about how much discount that they have passed for that particular product and whether the same has been put in the valuation of the GST or not. So this becomes really necessary. So I guess I have covered a measure of the parts in the balance sheet, and I think we should open the house for the question answer round now, with your permission.
Sir, I have already asked you some questions which was raised by the various members. One question is also there again. What is
Yeah.
fraud risk in such type of industries?
So there is a lot of fraud risk. Again, I'm telling you, if you get to read the contracts first, the contracts are very much necessary in the complete industry because there are back-to-back contracts which are made by the head office. The complete deal is set by the head office, which is not there in India. Only the India unit is just doing the manufacturing exercise only, or they are just doing their part of warehousing or wholesaling in India. The fraud risk, which is very important to understand here, is the base erosion and the profit shifting here, because a lot of times they engage into the activities which generates a lot of we can say a lot of margins. However, that margin which is at the end of the year is not justified by the margin that they show in their books of accounts, because you'll get to see a lot of payments have been done, and how the payments have been done, they get to make different understanding with their own head offices. And when you do the thorough audit for the same understanding, let's say they have given a FTS for their own head office, but when you get to see that the complete factory is being run in India, there is no such intangible that is needed from the head office to run this factory in India. However, the technology part, except the technology part, the other parts are being maintained. There is a complete CFO in India. There is a complete CTO in India. There is a complete unit which is being run. But again, a huge amount of money is being paid in the name of FTS or royalty, you can say.
Royalty, yeah.
So then it becomes the standpoint of view that the Indian authorities also see it from the fraud angle.
Right.
Because
And
this again
another question is there.
the outflow of the Indian money which is going.
Right.
Yeah.
What are the common key audit matters for these type of companies?
Sir, I have been talking since my deliberation started the key points for this.
Key points.
Just to
You already
just to
explained
yes,
for the
a lot
different
of points
industries.
I've already explained about these
Right.
companies.
Agreed, sir. And you have actually taken the practical experience also, because you have also covered the GST portion in that.
Yes, that is
Best thing is
that
that.
is the key of running this session, because a lot of not just GST, TP is also a very important aspect with these companies, because these
Right.
companies engage in a lot of transfer pricing worthy transactions with their own head offices and with the third parties which are deemed international transaction parties. This I just you just reminded me of this deemed international point. So the tripartite agreement, you will get to see a lot of companies which make tripartite agreements with their customers, where the terms of the agreements have already been decided by the head offices, and yet they are not showing these transactions as deemed international transactions. But once you get to read the contract between the customer, you will get to see that the entire contract has been actually negotiated by the head office itself.
Head office.
So this itself is a deemed international transaction that needs to be covered up in the 3CEB point of view.
Right. It's a very, very important point, because
it is.
most of the time we ignore it.
But that is what I'm telling you. In this particular
Not intentionally,
industry,
but it is by chance. It's a very, very important, I think.
because auditors many a times do not show it in the related party also, because if you see the related party definition from the point of view of companies, that you will never get to see the related parties here.
Right.
And
This point
there
to
is
be noted.
another point
Even
which
this point to be noted in my opinion, this is to be checked in almost all the cases.
yes, sir, it should be checked in almost all the cases. However, we do not check it practically, because only the TP provisions are bringing the deemed international transaction into the picture. The other provisions are not putting into the picture.
Thank you. And
Yeah.
one more question is there.
Yes,
Can you
sir.
share your practical experience in area of assessing risk of material misstatement specific to ESDM sector?
Yes, sir. I can share my practical experiences onto it, but again, I would not like to name the companies at all.
Yeah, definitely.
So, the material misstatement that happens, that as you stated, the first point where the complete material misstatement happens is the revenue recognition. As I've been telling, that the closing entries which are there for the closing inventory which is being sold during the closing dates, they never reach the customer, and the customer never recognizes it as its expenses for that time being. However, because we have to sell the material, we have already issued a tax invoice on it. Then because of that, we have to include the same in our revenue recognition. Now this becomes a point of conflict again. The GST department will say, since your material has already been transported from your factory premises, it needs to be held with a tax invoice. E-invoice needs to be generated, e-way bill needs to be generated. However, from the point of view of accounting standard, if you see that the risk and reward for the same has not been transferred yet. How can that be? How can that be recorded? Then it becomes a scope of creating a misrepresentation in terms when we say that this is a material misstatement in terms of revenue that is coming. Again, a revenue which is being recognized from the IPRs. Most of the time, the IPR lending is also happening. Even if we don't know whether the IPR which has actually been transferred has been used by the other factory or not. However, to adjust the profits, various times it has been seen that the companies, they account for the incomes from the IPRs. So that again becomes a point where we need to be very much cautious. Then again, the payments that I have been telling you before, the payments for these IPRs, the royalties and the FTS to adjust the expenses, to adjust the profit margins. That becomes a huge amount sometime in the balance sheets, to which the tax authorities also object. Because when they litmus test the same on the grounds of whether the service actually has happened or not, then it does not sufficiently gives the proof that whether there was a service or not intact to it. So then again, point of misstatement happens. Then, sir, as I told you, the depreciated assets majorly, whenever a factory is being set up, sometimes the depreciated assets are also being transferred.
Yeah.
And a PLI scheme benefit is also being taken on that. So from the statutory auditor's point of view, it becomes very much necessary to identify whether this particular asset which has been bought to the company, whether it is a new asset, it is a back-to-back purchase, whether there exists an invoice for the same, or it is a depreciated asset which has been bought. And in case it is a depreciated asset, whether the valuation of the same has been incorrectly or not. Because what we believe in as an auditor sometimes is that we just see that whether the custom authorities has given a bill of entry for the same, the assessable value as per the bill of entry is correct. Whatever the assessee is showing it to us, and then let it be.
Right. Right.
So we have to be a little more cautious about, because when it comes to again the point of TP, it becomes a problem for the assessee again. The audit becomes into the problem.
Sir, one another question is there. It is about KAM, key audit matters as per SA 701, which is we disclose in audit report.
Key audit matters, sir, I have already spoken about it. The key audit matters for this in particular, in case you find that there is a payment. Again, I'm stressing upon the payments of FTS and royalties, because these are very major in this sector. In case you find that there are FTS and royalties, you should report it. As an auditor, I would never recommend you to let it unreported. Put a other matter para. In the other matter para, you have to report this transaction which has happened. And every year, if you get to see, you report it every year. Don't leave it behind, even in the notes on accounts. And from the TP point of view, there is another important transaction which is just coming to my mind. I should tell you. Sir, there's secondary adjustment always. Whenever there is a primary adjustment for more than 1 crore rupees, in case there is a disbalance in the TP, as per the TP assessment, there is a disbalance between the prices that has been charged or that should have been charged of more than 1 crore rupees. It is said that the secondary treatment of the same has to be done. The secondary treatment talks about that the money either should be paid or should be received in real. And in case the same has not been done, the same has to be bearing up interest upon it, or a tax has to be paid on it, treating it as a dividend. Sir, you'll never get to see this transaction in the books of accounts, because no company in practical passes a accounting entry for the primary or secondary adjustment in their books.
One important question is there, sir. It is really a very good question. How to recognize PIL scheme in case fraud is detected?
Sir, that I will not do, that the department will do.
The department will. But what we have to
The
mention in our audit report, we have to
Sir,
mention.
we have to mention in our audit report in the other matter para, since it is not actually directly impacting the financials as a missing statement.
Right.
But in case you find that the PLI scheme does not permit certain kind of an activity and that has been taken care of by the company, then you must mention in the other audit matter para.
I will not take the name of the company, because in the last 2-3 months back, one EV scooter, there was.
I know about the company that you are talking of.
Yeah. So how it was found?
Yes, sir. Auditor will be found and they will be grabbed with the neck only.
What is the
This is the-
responsibility of the auditor in that case, sir?
Sir, this is the problem nowadays, that everyone is running around the auditors for these other things also. That is why I'm pressing upon that you use the other matter para very wisely and very well. Whenever you see in these particular companies, because a lot of investment is coming from, I would like to take the name. It's a lot of investment in these companies coming from China.
Yeah.
And ever since the huge money is involved, and the complete perspective of looking into the transactions of the tax authorities has also changed completely. And the government authority has changed for these companies. So being the auditor of these companies, you have to be very much cautious about everything that they do. If they are claiming an export benefit, if they are taking a PLI benefit, you need to be extra cautious about what they have shown and what are the constituents of their benefits that they have made a claim of. right?
We have to check the claim documents also, this means?
Yes, sir. I believe we must check the claim documents also. We must check every month's return that they've chosen also.
But we can't check the delivery, physical delivery of the
So there are always PODs in such a case. You can do that on test check basis because all the PODs would be always there. This particular sector works basis on the PODs that the material has reached, the POD is there, it is always there on the mail also, it is always out there on the physical mode as well. Right, the transporter would always be involved into it. There would be e-way bills also, so you can always test check the actual delivery of the material. The problem case here in the PLI is the taking advantage of the investment that is already there. The plant and machinery is the most important factor that I have been like I may be repeating it for the third time. But this is very important that the second-hand plant and machinery is being bought in India and the PLI scheme is being taken on it.
It's really very dangerous thing, because we are taking the second-hand machinery. And
yes, sir.
Providing this scheme
majority of the time they do their self-certification. They don't even take the engineer certificate in India. They don't take their engineer certificate in their home country. They just do the book valuation and put a little margin onto it and they just send it to India.
Right.
So this becomes really dangerous for everyone who is revolving around that.
But sir, in such cases, auditor can't do anything now because we are dependent only on the chartered engineer certificates and the other documents.
So that is what I have already mentioned here, that in case there is a plant and machinery that has been bought by the auditee from the head office themselves. Because majority time what they do is that at the initial time of making, the head office actually procures the material from outside and they sell it to the Indian company. Because it is their own subsidiary company. So it becomes easier for them to get it clear from the customs also. Instead of getting it directly billed from the source supplier to India.
Right.
So there in case we have to check whether we have a back-to-back invoice for the same or not.
How can that be verified, sir? It's very difficult because
we can ask for it always.
We can always
ask for it. Yes. The head office will provide it. The head office will provide it whether it is a back-to-back material purchase or whether it is a second-hand material purchase. Even in PLI declaration, they have to give it. Whether it is a second-hand material purchase.
We can directly email to the manufacturer also?
Not to the manufacturer. Because I believe that in that case, manufacturer will never respond to us.
Yeah.
He'll never respond to us.
Right.
You have to always ask for the document from them. Even after doing that, because bringing the plant and machinery to India, that will be covered in the TP provisions also. Even at the case of 3CEB or at the time of making your TP report, you have to disclose what method that you have chosen for the arm's length pricing. So that auditor can always see.
Right, sir. Right.
Yeah.
And one question is, sir, there, the point of sale defines revenue recognition on which GST has to be complied with. Is there any challenge on that?
So that is what I had explained just before.
Already explained, right?
I have already explained that.
Yeah.
Just a few minutes ago, I have explained on it.
Right.
So in GST and 9C, if there would be a difference in GST and 9C, that needs to be taken care of. In the reconciliation statement.
Reconciliation statement, right. But you have to maintain all the data also now for that.
Certainly, the entire data has to be maintained.
Most of the auditors are doing the same thing in the past also.
Yeah, majority of the auditors do the same way. At the time of VAT, it was also there. I guess there it was also very much discussed at the time of VAT was there. Service tax may it was I clearly remember that whenever there was a royalty payment, service tax was one of the point that we need to take care of.
Right.
And sir, is industry ke andar in particular that I have been stressing upon key, there are a lot of services that are bought free of cost. So whenever there is a free of cost expats agar India mein hai and their services are not being charged on the Indian company, so then there would be very high chances that those expats can be treated if they are running a project on behalf of the company in India. Then there are very high chances in which their head office is also involved. So based on my practical exposure onto this industry, I can tell you there are very much high chances that those expats can also be treated as the PE of their head office in India. Right. So from that point of view, it becomes very much necessary for us to understand whether in case of these FOC services, they are charging for it or not. And also from the GST point of view, because these are FOC services from the related party, a GST and a reverse charge needs to be paid on it.
Right. It's a now very complicated one. We have to check each and every step.
Yes, sir. That is why for the statutory auditor, it becomes a Singhasana of thrones that you have to be the stat auditor of a big company where the numbers are huge, the transactions are very much huge, but you have to pull each and every string. FEMA comes to the picture, RBI comes to the picture, your GST,
Sir, even
custom,
day to day,
everything comes to the picture.
Sir, even day to day, you have to read the newspaper regarding that company, what they are doing.
Yes. What they are doing at the end of the day, you will get to know someday their MD is arrested by the ED, and then you are doomed.
Right. No,
So,
means
so
full year involvement is there required.
yes, complete year involvement is there. Just like we do it for a
Not
big
only on the
PSU.
last, but even
That is what I'm saying.
from
Just
the
like a
beginning.
big PSU that we do every day, every other month, we have to keep calling them and seeking for their data and do the audit. It is the same way we have to keep a very close eye on the transaction of the client in this
Right.
particular. I always recommend that in such case the volumes are very high. A quarterly or a monthly audit is always good. You can run a quarterly audit because that way also you'll get to understand about the ratios which are changing in terms of their profitabilities. Because by the end you'll get to see that there is something which they have done which is actually challenging their profitability a lot.
Yeah, definitely. It will helpful for the auditor also.
Yes, for the मैं वही कह रहा था कि for the smaller auditors as you have asked, for the smaller and medium practitioners that you have asked, so it becomes really hard for us being a small and medium practitioner myself. It becomes very hard for us to put the team every time, every month or every quarter for the audit. But yeah, we can always ask for the data from the client, or we can visit once in a quarter, or let's say in a semi-annual audit we can conduct. So we get to have a grip over the client's work, which is
Yeah,
there.
sir. Even while filing the GST returns, even the data can be compared. What was the happened in the last month?
Yes.
Why it increase or decrease
So
drastic?
basis the increase and decrease nowadays, many a time DGCI is also bringing up a lot of queries.
Not.
They send a query to the range officer, or they sometimes send the notice to us that your last month's or your last quarter's profit was this much according to us because you made this much of purchase and this much of sale, and this much was your cash utilization. However, this was your credit utilization. Whereas this month again, the cash utilization has become almost zero and your credit utilization has become this high. So how come your profit margins are squeezing up so much in month-on-month basis?
Yeah. Like
When you're maintaining the same level of sale.
complete watch also there by the
Yes,
department
there's a
also.
complete department there. See, the system is doing the complete integration. The system is doing the complete work for them.
Complete one.
I have seen the system from inside also, and I know that how the system works actually. So they do a complete comparison every month-on-month basis for each and every client. They put their own triggers. They push it to the officers. Officers they get to analyze it themselves, and then when they feel that yes, there is something which needs intervention here, so then they put the query on the either on the range or directly to the SSC.
Thank you, Utsavji. It's a great session. Because I have actually in the beginning I was thinking यार ये मेरे मतलब का नहीं होगा because I'm but you have put it in such a manner because you have covered all the things, even GST, income tax, and audit, and made it a interesting one. So you can ask, you can check how many questions are there, and even I have learned so many things from you.
Thank
And
you so
it's
much.
really a great session, sir.
Thank you, sir.
So, thank you so much, sir, for such a wonderful deliberation. As Jatinder sir was saying, he has learned, even frankly speaking, I have also learned from your deliberation, and it was really very remarkable, and you uncovered all the aspects relating to this sector, because I was also a little bit in dilemma ki kya hota hai is sector mein, and it is a different sector, but frankly speaking, I have gained a lot through your deliberation. Hope our members have also gained a lot through your deliberation. So thank you so much for giving your this time as well as precious expertise for AASB as well as for our members, and given your kind consent, even apart from having your busy schedule, you have kind consented for our this webinar. Thank you so much on behalf of AASB of ICI. I also thanks to the past chairman Amritsar branch C.A. Jitendra Bansal ji for your precious time as well as for the moderation of this particular webinar, as well as time to time your inputs for this particular webinar. Thank you so much, sir. Thank you so much. Thank you.
Thank you so much, everyone.
Thank you, sir. Namaste.
Thank you,
Thank you,
Jitendra
sir.
ji. Thank you.
Thank you, sir. Thank you, sir.